Our mission at SD Bullion is clear: the lowest cost gold and silver available online. While we do not have pretty blue boxes, free shipping, 4% credit card fees, or glamorous gold and silver infomercials, SD Bullion has the lowest prices that may save you hundreds on your next order. So before you make your next investment, do the math and join the over 15,000 new customers who have recently made the switch to SD Bullion. Why pay more?
This is the Doc and Eric Dubin with the SD Weekly Metals and Markets Wrap. Joining us today, in perfect timing yet again, is our good friend from the other side of the pond, Alasdair Macleod. Alasdair, it's great to have you back in the show.
It's very nice to be back on. Thank you for asking me.
And with the perfect timing, that with Draghi over there on your side of the world announcing another surprise QE yesterday on Thursday. Let's start out with that, Alasdair. What's your take on the QE in the markets?
Well, I mean, it's where do you start with someone who actually doesn't know what he's doing? I mean, it's actually quite terrifying. I mean, he's reduced, or rather, he's increased the negative deposit rate to 0.4%. He's taking moves to bolster asset prices so they never fall, and that now includes investment-grade bonds issued by non-financial corporations. And he's also doing these long-term refinancing jobs, basically where he pays the banks to take money off his hands to go and lend to someone else. But what nobody seems to mention in all this is that the banks in the Eurozone are already highly overgeared. And because they're overgeared, actually, they can't lend to anyone. I mean, it's, the whole thing is just a complete nonsense. It's difficult to know what else he can do simply because everybody expects him to do what he's done. And if he doesn't do what everybody expects, then the whole world falls apart. So I have some sympathy with his position. But what a ridiculous situation to get into.
And the market response, too, is pretty telling because initially you have one direction and then all of a sudden, currencies go wild and shift in the other direction. So, I mean, there's just an underlying instability across all financial systems with this rot in the shadow banking system, and everything is highly volatile, and the stress is here. You can see the creaking in the financial system. Even Zero Hedge recently put out an article, I think it was this morning, talking about the failures to deliver in the Treasury market in the United States. They're once again just shooting through all-time records. There's a lot of stress in the credit system, and you don't need to look very far to see it as it translates into this unusual volatility and what's going on in the credit system.
That's right. And I mean, the irony in the situation is that the more the central banks corner the market for high-quality debt, the greater the strain they put on the shadow banking system. And that's really what this is about. Absolutely. No, I agree.
And when the confidence is underpinned by all of these machinations to support this fiat structure coming under pressure, here we are. The bull market and gold is reasserting itself. And you've written about that over the last couple of weeks. I'd love to chat with you about your perspective of where gold is and silver catching up and gold-silver ratio, all that good stuff. What's your take on where precious metals are?
Well, it is a fascinating situation because if you cast your mind back literally just 2 months, everybody was incredibly bullish of the dollar, which meant that they were bearish for gold. And major investment houses were talking gold down to, $9.50 an ounce? Figures like that. And ever since then, of course, what's happened is that because everybody is long of the dollar and short of everything else, the last buyer of the dollar has already bought, so there was nobody left to buy it, so the dollar goes down, and bingo, gold shoots up. And now we have a situation where, technically, there's a golden cross underneath a rising gold price, and interestingly as well, there's a Pennant Formation, and I had to look up my old edition of Edwards and McGee to remind myself what all the conditions behind a pennant are. And it is absolutely textbook. And what it basically means is that the distance from the breakout up to the pennant, when the pennant is completed, which it now has, basically you can add onto the price from where the pennant completed to give you a target for the gold price on the second half of the run. So we're looking at a gold price of a minimum of about $1,400, and it could actually happen quite quickly. And all this comes out of a situation where everybody was so bullish of the dollar and so bearish of everything else. The whole thing's just turned on a dime. It is quite extraordinary. And of course, the major investment houses haven't managed to catch up with it. And I think it's an interesting situation because when I look at the commitment of traders figures and I look at the the daily open interest and I see how that reacts with the price, we have a situation where, two things worth mentioning. The open interest hit a record this week of just under 500,000 contracts open. That's 500,000 short, 500,000 longs. What's happened is that in order to sort of slow down this rise, extra paper gold has been produced, which is the equivalent of 391 tons of gold to slow the rise. And has the rise slowed? No, it hasn't. It's actually been really very, very strong. And what I now detect is that the traders in the bullion banks aren't doing what they have done on previous runs, and that is, they sort of let the market have have a bit of give it its head, as it were. Then there's a moment where they hit the market and they can actually manufacture more paper, 10,000 contracts, whatever, just hit the market and watch you take out all the stops and watch everybody turn bearish. That's not happening this time. And if you want evidence of it, look at the what's going on in the ETFs. Right. You mentioned the zero hedge. There was a zero hedge article the other day. I don't know if it's right, but I assume it is right, that for the past 40 days, every day there has been net subscriptions into gold ETFs. This is telling me that there are a lot of people out there who, okay, they may be buying the trend by buying ETFs. Of course, there's a large element of that. But I think there is an underlying sort of element of funk money, if you like. Money which just is a bit frightened about being in the banking system and just wants to have a little bit of insurance on the side. And it doesn't take a lot, really, to clean all the vaults out of loose bullion. And I think that is the underlying situation that the traders and the bullion banks are seeing, and I think it worries them.
And it sure doesn't take a lot of money to move precious metals because of the size of the market relative to everything else and the size of everything else.
Well, you say that. I mean, it doesn't take a lot of money compared with the past, but we're still talking about some very, very big shifts going on.
Oh, yeah, yeah.
Just to put that number in perspective and put a punctuation point on those comments, at SD Bullion, we've had a customer who was looking to make about $10 million worth of purchase in silver bars. And in talking to Scotiabank, one of the larger bullion dealers, the reaction was almost one of freaking out, and they literally told us that we'd move the spot market 30 cents with that kind of purchase, and if they actually wanted physical.
Wow.
Really, that is interesting. Yes, that is interesting.
And just this last week too, we had BlackRock suspending the issuance of new shares for their gold ETF because, frankly, they can't source the gold to create the shares.
Well, that's not quite the problem. I mean, that's what it looked like to begin with. But actually, it transpires that what had happened was that there's been so much demand for new ETF shares from that BlackRock ETF that actually what happened is that they issued more shares than their authorized capital. So what they had to do was they had to quickly call an emergency, I suppose an emergency EGM or whatever, tell the market and all the rest of it, and to sort of get the situation back under control so they could actually issue the stock. How they've done it, I don't know, because if you over-issue your authorized capital, it's not something you can just fix like that. So I think what they've had to do is to do lots of sort of contingent agreements and all the rest of it to get it through. But that's what it was. It wasn't a shortage of underlying bullion. But it does show just, they were caught with their pants down. They didn't, they should have looked. They didn't look. They didn't think it was, they were anywhere near their authorized limit. And bingo, they were over it. It's an extraordinary story, certainly.
And a little more on the physical numbers. At least here in the U.S., gold and silver numbers remain strong. U.S. mints up to 12 million coins sold already through, what are we, about 9 weeks into the year? And I mean, really, they started taking orders for coins end of January, so about 6 weeks into their order cycle, we've sold 12 million coins. So obviously it's still early, but definitely record pace to start 2016.
Yeah, I think so, yeah.
And GLD has also been hoovering up, and it's just an enormous amount of physical too. At least according to what they claim. I'm still skeptical of what the whole BlackRock situation is, because I don't think we know everything as far as how that all went down. But we'll see.
Yeah, I think what we can agree is that there is an awful lot of demand for gold ETFs. Now, whether some of it is, sort of geared, or how much of it is actual physical ETFs. I just don't know. But the demand is there, and it doesn't actually take an awful lot of demand, basically, to clean out the overall market, which I think was the point that you were trying to make earlier, Eric. We're seeing that, and I think it's going to continue. I mean, the point about the Eurozone is that in the Eurozone, you've got, about 300 or 400 million people who are now earning less on their deposit accounts than they would have to pay in storage fees for bullion. I mean, sorry, it's the other way around. I mean, basically, it costs them more to run a deposit than it does to pay the storage fees to hold bullion. And I think it only takes just a matter of time before people sort of wake up to the thought, well, rather than have my money doing absolutely nothing and maybe being taxed, perhaps what I ought to do is look at alternatives. Of course, you've got equities, you've got, some of which pay dividends. You've got bonds, but I think roughly, it must be close to half the total of sovereign debt bonds in the Eurozone are now negative yielding. So what else have you got? Oh, gold. Perhaps we ought to have some of that. And the point is that now that the trend is rising, I think there are lots of people sitting there who are thinking, we better act quickly or we're going to miss it. And if they feel that they've missed it, they should start looking at silver, which has actually lagged behind gold this year so far.
Yeah, that definitely appears to be some shift in the sentiment of the people in the trading community, because they're no longer willing to play the game of letting central bankers have their back, and they see what looks like an end game unfolding. Equity markets unraveling, and currency wars continuing onward, and this whole shadow banking stress within the system is changing behavior. And the whole Pennant Formation and the technical picture that you described before is very telling too, because we've seen at the very worst just horizontal consolidation after big moves and very little traction to the downside whenever we would see profit taking and cartel attacks. It's very different behavior in the last couple of months, and the continuation of disbelief in the mainstream is a good thing too.
Yes, I mean, well, I think it's completely consistent with this stage of the bull market. You find that people just don't understand it. They're sort of looking at it and saying, well, I just don't understand gold. I don't understand why it's gone up. It doesn't make any sense to me, so I'm going to leave it alone. I'm not interested. When people like that are interested, generally it's a sign that you're coming up for a bit of profit taking. Unless, of course, the interest is a genuine late conversion to a real fear of owning anything else, which, of course, I think could. I mean, this is the signal that we're getting both from the Bank of Japan and the ECB. They are very close to the end of the road of trying to keep their economies somehow stuttering along, and keeping their banks intact too. I mean, because the point, which I think is the most serious one I've made, is that it's all very well trying to encourage the Eurozone banks to lend, but they are so highly geared. They have not done what the American banks have done. The American banks have recapitalized themselves. I mean, you know, they could have recapitalized themselves a bit more, but basically they have gone out and they've taken steps to bolster their underlying equity. The Eurozone banks haven't. And all that happens is that the share prices continue to collapse, and it makes it more and more expensive for them to raise capital. And how they deal with this one, I really don't know. I suppose the next thing is the ECB turns around and says, okay, we will buy Deutsche Bank and SocGen shares and some, I don't know, Montepaschi shares. We will buy them at a premium to the market. Well, I mean, stranger things have happened. Yes. But I mean, logically, that's the next thing. You know, the ECB effectively starts buying shares and injecting capital into directly into the banks. But I mean, that is just. I don't think that really helps either, in a sense. But I can see they're getting pretty desperate. And I think the next thing that we could see is that the ECB turns around and in effect says to the Eurozone governments, well, we can't do this on our own. You're going to have to do some fiscal reflation, which basically means the end of austerity. It means highly indebted governments, taking on more debt or certainly not paying down their debt in any way. It means they're going to turn around and tell the Germans to, sort of increase their budget deficit and all the rest of it. And I think at that stage, it's going to be sort of a real, if you like, well, A, reality check, and B, I think that, Germany is going to just begin to think, well, where is this going? Is this something we have any control over?
Yeah, the finance minister was sitting adjacent to Draghi at one point, and his looks were priceless.
Yeah, well, I didn't see that, but it wouldn't surprise me at all.
Looks of horror and disdain.
Yeah, well, Schäuble he's a lawyer apart from anything else. He's not a he's not a Keynesian economist or anything like that.
Right.
He's a sort of a hard reality man, as the Greeks found out.
He has a prickly personality and reputation for it as well.
Well, they just found it impossible to negotiate with him, and
Yeah.
he takes a very loyally attitude to life. You have entered into a contract with me, and you can damn well stick to it.
Right. So with all of this turmoil in Europe, I mean, it almost seems like it's a farcical fantasy for the Fed to even contemplate normalization of interest rates, and the markets are beginning to recognize that. And we spoke about the dollar having trouble in this year, surprising everybody. Do you think that we have the Fed meeting coming up in next week, and expectations are going to be there's going to be a lot of jawboning and so forth about trying to paint the tape, and claiming that interest rates will continue to be normalized, and the Fed did come out and make a lot of talk about setting the table with their 4-rate interest rate plot map, and then backtracking on all of that. And we've had Yellen come and give testimony to Congress, even hinting at the possibility that negative interest rates are not completely off the table in the United States. So they're kind of dancing all over the place when it comes to their public relations posturing and whatnot. I'd love to know what you think as far as where the U.S. Fed and U.S. economy is going to plug into all this, and what you think the Fed is going to do going forward as far as interest rates are concerned, and how that spills over to the precious metals market.
Well, I mean, I expected the markets to start talking about negative interest rates in the United States. I didn't actually think it was going to happen. I mean, I think I wouldn't rule it out, but I didn't think it was going to happen. Now, having said that, I think that things have changed somewhat, because the point about the dollar's purchasing power falling against key commodities is that, from the Fed's point of view, if they're trying to gauge where inflation is going to be, say, in a year's time, what they're seeing is that the fall in prices, like manufactured goods imported from China and all the rest of it, those are going to be dropping out of the back end of the statistics. Coming in at the front end, you're going to have rising raw material prices and the effect that has on a number of items within the consumer price index. So already you can see the situation setting up where with no increase in economic activity in the United States, the rate of inflation could be prospectively quite a bit higher than 2% within a year's time. I'm not saying that's going to be the case, but I think there is actually a very serious possibility that that is going to be the case. The Fed will start looking at that, and their problem is going to be managing that. Now, it's a very different one from the one we have at the moment. I mean, we're all saying, that the world's going to the hell in a handbasket. Global trade is contracted. You look at things like Baltic shipping rates and all the rest of it. And how can America be immune from this? The answer is it's not immune from it. And the level of debt that you have within your economy basically means that already, with a very anemic economy, that is enough for highly indebted businesses to begin to fall over. So, it's not a good situation. But you've now got a problem where you're going to have that situation continuing. And at the same time, the Fed might well come under pressure in the next 6 months to start considering raising interest rates and therefore increasing the bankruptcy rate amongst the highly indebted businesses in your country. So what I'm suggesting is that there is a flow going out of the dollar, which I think is going to increase in momentum, and I'll tell you why in a second. But as that increases, the effect will be to lower the purchasing power of the dollar against commodities in particular and bring in an inflation problem in the second half of 2016. Now, the reason why this is becoming a serious issue is China. China has been cleaning out its stables in a way in which only China can do it. They own the banks, they control an awful lot of businesses. Basically what they're doing is they're writing off an awful lot of debt and they're refocusing the economy. And the reason they have to refocus the economy is because they need to free up the labor in, if you like, the sort of legacy businesses making cheap stuff to export to Europe and America and all the rest of it. To refocus that labor, train it so that it is producing more higher tech stuff, services for its growing middle class, and importantly, they have a program with their 13th five-year plan, and it's going to go on to the 14th and the 15th and the 16th, to fill in, if you like, with their own infrastructure, make sure that their infrastructure is up to scratch. They've got a lot of investment to do in their electricity supply grid nationwide, for example. And the other thing that they're doing is they are investing in infrastructure throughout Asia. It's not just Silk Road. They're talking about investing in an industrial revolution for what we're talking about, nearly 3.5–4 billion people. I mean, this is massive. They're going to do what we did in 200 years. They're going to do it in 25. Now, they have a situation where they're sitting on a whole bunch of dollars as part of their foreign reserves. They need the raw materials. They have come round to the view that they value the dollars less than they value the raw materials. So they're going to be selling dollars, buying raw materials. They have set up their currency to take the strains which are implied in this operation. The first thing they did was last year, they lobbied and succeeded to get the yuan included in the SDR. That means that all central banks have to hold some yuan. The second thing that they have done very quietly is they've turned around and instead of targeting the yuan against the dollar, they're targeting it now, or they will be this year, this new Chinese year, against a basket of trade-weighted or whatever international currencies. Now, this actually makes it far harder for someone trying to short the yuan to actually short it, because you haven't got a fixed target anymore. You know, it's a bit it's a bit more difficult.
And correct me if I'm wrong, too. Isn't that the case that they were not specific in outlining, the percentage components of this basket, that it in fact can move, that they can jigger it at will? Is that not
absolutely.
the case?
Yeah, no, absolutely. I mean, that's also my understanding. I mean, but the reason you do this, quite simply, is you make it harder for the speculators to speculate against your currency.
Right.
And you know, that they've now achieved. Now, having done those two things, getting the yuan into the SDR and changing the focus from managing it against the dollar to a basket of currencies, which they will determine from time to time, will allow them to wind down their dollar stockpile in return for stockpiles of crucial materials. Now, this is important because this changes the whole global scene. All those bad debts in the commodity sector, you know, some of them are going to remain bad debts. But on the other hand, you can see already that share prices of companies like Glencore have tripled virtually. You know, the RTZs of this world, the shares have risen very strongly. BHP, risen very strongly. All these sort of basic industrial material producers, suddenly having been incredibly oversold, they have bounced. And there is good reason for this, because the word is going out that the Chinese are going to be re-entering the market and accumulating the raw materials that they reckon they're going to need over the next 5 or 10 years. And the thing that drives them into doing this is a stack of dollars, which they reckon are worth considerably less than the raw materials that they want to buy. And so this changes the whole world round from where we were when the dollar was rising and nobody could understand why it was rising and nobody could stop it rising. And we just sort of thought, well, everything else is going down, so we've got to hold the dollar. That was, if you like, the risk-free trade. That has now changed. Very important point.
Yeah, and that fits in very well too with the macro picture when it comes to central banks jiggering interest rates and what the Fed is faced now with too. I mean, the Fed's worst nightmare would be the dollar rising past, say, for example, DXY over 100, and you know, the stress that would come into the financial system translating throughout because of rising dollar.
Well, they've now got, actually, I mean, that has been you know, sort of a concern, and that concern potentially was going to drive them into negative interest rates. What I'm saying is that the concern is going to change from that to something totally different, and that is that if the purchasing power of the dollar goes down, that means that price inflation is going to start rising. Now, if the response to that is that the Fed has to raise interest rates of 2 or 3 or 4%, think what that does to the highly indebted businesses in the United States. Think what it does to the US government in terms of its borrowing program. Suddenly you have got a whole different problem. And it's a problem which actually I think they would rather have less than the problem that they have at the moment.
Yeah,
because
it's a stagflationary trap. They can't get out of it.
Exactly. That's it. You've got it. It's stagflation. I mean, what you've got is you've got inflation picking up really on the back of a falling purchasing power of the currency without an underlying increase in economic activity. It's as simple as that.
It's going to be a very interesting year.
I think it will be. Well, but you can begin to see now why, you know, the sort of, if you like, the fundamentals for gold are beginning to look a lot more interesting. And you can see why, because nobody actually thinks in the market that, you know, it's the dollar going down. They think it's the gold going up. And if you sort of think gold's going up, you think, well, what's changed? You know, why is gold suddenly going up? What's different about gold today from yesterday? I don't know. Perhaps it's, you know, it's just, perhaps you ought to sell it because it's just complete nonsense. If you understand instead that actually what's happening is it's not gold going up, it's the dollar going down, then it begins to make a lot more sense. And the mainstream in the markets, they do not understand that. And that is why they haven't cottoned on to it.
Yeah, this is also a reflection of the time delay of excessive monetary credit creation. You know, we had for years heard people say, well, where's the inflation? What's going on? You know, the velocity of money crashing, et cetera, et cetera. And then the arguments since 2011 have been, well, this fully justifies why gold has been, you know, languishing, and that the bull market is not going to reboot. And you know, since January 1st, quite literally, I mean, the beginning of this year, sentiment has shifted around, and it's in a process. It's a dynamic change. And as we go through the rest of this year, I suspect that people will increasingly think that, the interest rate normalization mirage is a lot worse than even what the Fed is trying to hide. And the dollar the purchasing power across the board and all currencies are going to go down. And the reflation against commodities makes perfect sense.
Yeah,
I fully agree with that thesis.
Yeah, no, I think that's right. I mean, it's you bring in another point, and that is that the way to measure the dollar is not against other currencies because they all suffer the same faults, if you like.
Yeah.
I mean, I think this stagflation problem. I mean, it's been fueled by so much money printing, and the money printing is really, I suppose, almost. Replacing or at least augmenting the creation of bank credit. The effect of this is the fuel behind it is just so incredible. It's hard to see how it can stop. If you're going to protect yourself against a substantial fall in the purchasing power of paper currencies, which could turn into what they call hyperinflation, which actually is a collapse in the purchasing power of the paper currency, then you've got to get into sound money, and you're looking at gold and silver.
All right, well, with all that positive take, Alasdair, I think that's a good place to wrap up the show today.
I like your definition of a positive take.
Always great to have you on, Alasdair, and I enjoy just sitting back and listening to your analysis.
Well, it's been fun for me too.
Even when I'm not under the weather, when we have you on, I enjoy muting the mic and listening to your wisdom.
Dear, oh dear. My rant.
We can hear you coughing in the background very slightly.
Well, you just have to get well soon. I'm sorry to hear that you've got a nasty bug.
All right, so for the listeners who aren't familiar with Alasdair's work, most of it we publish on SilverDoctors as well, but you can find it directly at the Gold Money site, I think under Market Updates and Insights. He publishes a couple of weekly updates and analysis usually, so highly recommend that. Again, also we do post them at SilverDoctors.com as well.
I'm delighted. It's all about spreading the word about sound money. I think your listeners should be aware that actually I'm on a crusade to promote sound money. We go out and we earn, we work to earn some money to buy things. And that money is the storage of our labor, as it were. And to have governments steal from it without us actually being able to notice or quantify or send the government a bill or whatever by printing it is completely wrong. But of course, sound money, as we all know, is something that governments cannot produce, and that is gold or silver.
I think we all agree wholeheartedly. So, with that, we'll wrap up the show this week. We'll keep our eyes fixed on the markets, especially Sunday night, with the weekend to digest Europe's big moves yesterday. So it'll be interesting here if gold and silver continue to correct any further, or if they are off to new highs over the short term. So it'll be an interesting week next week, especially with the Fed midweek. So we'll wrap up this week's show there. For the Doc and Eric Dubin, thanks for tuning into this week's SD Weekly Metals and Markets.